All right, we're ready to start. Well, welcome everybody. We want to thank you for coming out. This is our first finance chapter meeting for Silicon Slopes in person for the last year and a half. And so we welcome you all out here. It was supposed to be a little bit cooler today, but it's still going to be a great day in the valley. So we've got some awesome material. As I tell people, I'm just a boring accountant. But the real smart guys are these valuation guys that come up with these big numbers for companies and how much they're worth. And so Jameson's the expert. So I just wanted to let everybody know that we're planning on doing kind of an event, CPE, or kind of a lunch and learn every other month as we go through the rest of 2021 and into 2022. So we want to welcome you. Make sure you get something to eat. We're going to kind of keep things a little bit informal. And so if you have questions, Jameson will take questions during his presentation. And then at the end, we'll wrap up. And so if you've got specific questions, feel free to ask him. It's kind of interesting. Jameson's got a great background. And he's worked with over 1,000 different companies for valuation. So he's probably seen it all. So let me introduce Jameson Jenkins of Scalar Analytics. He is the master of valuations. And today he's specifically going to talk about 409A valuations for privately held companies and what you need to do to be successful in your valuation. So, Jameson, thanks, Chris.
I can probably just toss it right there, right? So, awesome. So, nice to be here with everyone. Probably a little rusty on this. It's been a year and a half since I've been able to do it in person, but it feels good to be up in front of everyone. As Chris mentioned, today, first off, my name's Jameson Jenkins. I'm a director and a partner at Scalar, and I'll talk a little more about Scalar here shortly. And then we've been asked today to talk in particular about a 409A valuation. Most of you, actually I can't assume that, but I would assume most of you have a rough idea of what a 409A is, but I'll explain that. So about Scalar, first off, microphone up to my mouth. Okay, there you go. That must be better. So Scalar, who are we? We are a full service valuation firm, meaning that if something needs to be valued, we can value that. That can be anywhere from enterprise level, so what's my company worth as a total, all the way down to, hey, I need to know what my technology is worth, or what is this conversion feature worth in my convertible note. And we do all types of valuation. We do consulting, financial reporting, litigation, you name it, we do that type of valuation. Also, we are industry agnostic, meaning that I have had the chance to work with basically every industry. As you'd imagine, the primary industries that I work with would be technology, just because technology is the way of the world. And then also biotech is a very common one that I work on in particular. But it doesn't matter what your business is, we can value it, and we have valued that type of business. And then you can actually go to the next slide. One other thing just about Scalar is we are a highly qualified firm. We've got a CPAs, CFAs, ASA, ABV. A lot of those probably don't mean anything to you, but we've got the credentials so that if ever it were to go to audit, we know what we're doing and why we're doing it. And then on top of that, we work on about 150 valuations a month, and those range all across the board. You can see up here some of our services, but all across the board, anywhere from financial reporting, litigation, consulting, whatever people need. So today, what I was asked to speak on is a 409A valuation. And 409A actually came about almost 2 decades ago now. In 2004, I actually think it was January 1st of 2005, if I'm not mistaken, but 2004, 2005 time, the IRS came out and said, hey, look, owners, founders, co-founders, you cannot issue options that are in the money. You're having a bunch of companies that were getting ready to IPO, and they're issuing options to employees at a penny, and then it would IPO at $15, and they're taking a bunch of money, and the IRS is like, hey, we need some of that cash. So they implemented 409A, and 409A essentially is a way to say, hey, you need to fair market value, or you need to come up with a fair value as of today for stock options that are going to be used for compensation. If you actually don't mind going back 2 slides, today the agenda is fairly simple. In a 409A valuation, I like to look at it as really there are 2 steps in it. The first step is we want to value the business as a whole. So there's multiple valuation approaches, but the easiest way to think of it is we first need to have a value for the business before we can come up with a value for the price per share. And then the second piece is the equity allocation and some discounts, adjustments that we would apply. And some cap tables are very simple. That's an easy process. Other times, a lot of VC-backed companies have fairly complex cap tables, especially later stage, and that's where the equity allocation can get a little more technical. And we'll just talk high level on all of this. So now we can move forward. So we're going to go into valuation approach. There's really 3 main ways that you can value a business. I mean, this is what you learn in finance school. And there's a lot of different approaches within each of these valuation approaches, but the easiest way to think of it is, hey, look, there's 3 ways to value a business. There's a market approach, an income approach, and a cost approach. The market approach, a lot of times I like to use examples, but a market approach would be similar to if you want to sell your home or you want to sell your car, a lot of times you are going to look at something comparable. So if you have a Toyota, you're not going to compare your Toyota to a Lamborghini. Also, if you have a 300,000 square foot home, you're probably not going to compare it to a 10,000 square foot home, even though you can get it kind of a price per square foot. But it's similar with the market approach, where what we can do is we can take a look at a business and take a look at like businesses that are traded publicly or that have had transactions and find an implied multiple and then apply that multiple to the financials. We'll go into a little more detail on that, but a lot of times that's revenue or EBITDA. The income approach, generally, there's multiple ways to look at an income approach, but one of the most common ones is a discounted cash flow. The kind of theory behind this is that businesses are really worth what their future cash flows are going to bring in. So we look at those future cash flows and we discount those back to present value to opine on a value. And then lastly, there's the cost approach. The cost approach, in most cases, is the least used within the industry, and the reason for that is there can be a lot of analysis to it, but a lot of times, a cost approach would be, hey, you have $10 million in the bank, you're worth $10 million, or you have this amount of invested capital. Sometimes you can look at some other nuances to it, but the market and income approach are hands down the most common approaches. So now we'll go into the market approach and talk over, and I apologize, these slides, we have a PowerPoint and we were trying to convert it into Keynote and it didn't work. So this is kind of, it's a little messed up here, but still, we'll go into the market approach first off. Similar to kind of how I had explained it before, there's multiple ways that you can look at a company from a market approach. One of those is through a public comparable method, or really what you'd do is you'd look at publicly traded companies. So think about it from this perspective. If you have, if you are a business that's providing CRM, a CRM tool that has SaaS-based component to it, then what we can do is we can go out and we can look at some of these publicly traded companies, Salesforce, and pull their multiples. We then will take those multiples, and let's say it's a 10x multiple, and the subject company that we're valuing is doing $1 million in ARR. We'll then apply that multiple to applying on a value of $10 million. You can see down here the valuation multiples that we typically use for private companies would be either EBITDA or revenue, if the company's not making money, or if the EBITDA is just not stable. Most of the time we will use a revenue multiple. If the company has kind of stabilized, has stabilized EBITDA, they've proven that they can kind of project their EBITDA out as well, we'll use that. Revenue is much easier to predict. Profitability is a lot more difficult. So that's one of the approaches. Within the public comparable company, there's a lot of limitations, as you'd imagine. The one thing that we kind of always joke about within valuation is that there's always a range of values. And there is a right number, or at least you can land within a right number, but you can have very well qualified people do a valuation, and everyone's going to come up with a slightly different number. And the one thing that's for sure is that you're going to be off just a little, because there are a lot of assumptions. Some of the limitations is, first off, earlier stage companies, private companies, a lot of times what they're doing is something new. They're breaking into a new market. So to find a pure play publicly traded company, it can be quite difficult. On top of that, a lot of times, these publicly traded companies can be very diversified in their revenue streams. So even if there is a component within that blue chip company that does what the private company is doing, they also have hundreds of other revenue streams. Sometimes there's limited trading history. We see that a lot within kind of the cryptocurrency space, cannabis space, where limited trading history, the values can be all over the board. Sometimes the methods just don't give you a reasonable result. The perfect example there is before Slack IPO'd, we did a lot of their financial reporting work. And whenever they'd reach out and say, hey, look, we fundraised, the implied multiple was something ridiculous, right? We couldn't corroborate that with any sort of public comparable multiples or anything like that. So it's not always the best indication. Also, there's subjectivity in regards to the multiple selection and how we weight that selection. And what I mean by that is if we're looking at 10 comparable companies, there's going to be a range of multiples that we come up with. Well, we can select a median, we can select a mean, we can look at top quartile, bottom quartile, top decile, bottom decile. There's a lot of statistical ways that we can look at that. And a lot of times we'll base it off of size, growth, profitability, those metrics. That being said, one of the variables and one of the limitations really has to do with the statistical metrics that we're using. And then also the weighting that we're putting on those metrics. So sometimes we will look at the last 12 months of revenue. Other times we'll look at the next 12 months. Other times we'll look at financial year plus 2 or 3. And there's subjectivity behind each of those, and so that's some limitations within the public comps. So the next one under the market approach is very similar to the public comps or comparables, but this actually has to do with transactions. So these are transactions that have occurred in the marketplace a lot of times like merger and acquisition type scenarios, where we can still take that transaction value, we can look at the revenue, EBITDA of that company, and come up with an implied multiple. A lot of times the criteria that we're looking at, of course, we want to base it upon your industry, the industry that the company, the subject company is in. The business model as well, because even within certain industries, there's very different business models, ways that people make money. Also, size, where they're located, and not just where they're located, but where they're making money. We work with a lot of companies outside of the U.S., but their clients are here in the U.S. And then also, we want to look at kind of the relativity of the transactions. And what I mean by that is how closely have these transactions happened? If we're looking at a transaction that happened 15 years ago, that data may be stale. Whereas in most cases, we'll look at 3 years or less when a transaction has happened. Similar to the public comps, transaction comparables have very similar limitations in that you've sometimes finding a pure play or an exact comparable is difficult. Another big one, especially within the transaction space, is a lot of these private companies are not required to provide data. So we might not be able to pull what their revenue, what their EBITDA, even what their transaction was. So limitation of data. And then similar, this approach has a lot of the same limitations. The only other one that I'd say that we have to take a look at is sometimes transactions happen and there's synergistic opportunity. And a lot of times how we'd look at that is, would a market participant, if Microsoft came in and purchased someone for X amount, would other companies come in and pay that exact same amount? And sometimes the answer is no. So we do sometimes see some synergies that imply a multiple that's just not right. Okay, so we're still on I don't want everyone to kind of get lost, but we're still on market approach because there's a lot of different ways. We've talked over 2 market approaches. This is the last one that we'll talk about today in regards to the market approach. And this is when there's a recent security transaction. Now there's a lot of times when you hear recent security transaction, your mind goes straight to preferred financing. Seed series, Series A, whatever it may be. You've raised money from an institutional investor, generally some sort of VC, and there's a recent security transaction. In a lot of cases, that is a great indication of value, and we will use that as a benchmark, because if you have a sophisticated investor that's come in and paid a certain amount, it's kind of hard to argue that that's not an indication of value. But there's some other ways that recent security transactions that people don't think about as often. Some of them include convertible debt. We see that quite often. Also, SAFE, so simple agreement for future equity. We see those happening, especially for earlier stage companies. Also, secondaries. So we see a lot of secondary action going on over the last year and a half. But if you have founders, co-founders, even early stage VCs that have sold some shares, sometimes that can be a good indication of value. And then also any sort of LOI, recently we've seen a lot of activity within the SPAC space as well. So any sort of offer to purchase the business. The one thing that I do want to know is, although even if there is a security transaction that has occurred, there's a lot of questions that we want to ask. We don't just assume, hey, this happened, it indicates value. As when we hear about this, what we want to do is we want to talk over it, and I mentioned up here, was the transaction arm's length? And the easiest way to kind of think of that is, was there a willing buyer and was there a willing seller? And there's a few other things that we will look at, but from a really high level, the first valuation approach of the 3 is the market approach, and within those, I've touched on 3 of them. public comparables, transaction comparables, and then recent security transactions. Oh, and I already kind of talked on these, so you can actually go to the next. And I talked on this, I apologize. So what I wanted to do now is, so with the market approach in particular, does anyone have any questions for me? So Chris.
One of the questions I hear all the time is, I haven't had any revenue yet from my company. Can you still do evaluation using the market method or other methods even though I don't have any revenue?
Yeah, good question. So the question was, if I'm pre-revenue, can you value my business? And the answer is, it's worth $0. No, just kidding. But the real answer is yes, we can still value you. There's a lot of different ways that we would look at that. One of them would be a market approach, but instead of looking at a trailing 12-month basis, because that would be 0 times whatever multiple, we would look at either next 12-month or financial year plus something, if they had projections. Also, a lot of times pre-revenue companies, they have some sort of indication based off of investment. So that last piece where we talked about a recent security transaction, and so we can use that, and that's considered a market approach. Yeah.
I'm curious about convertibles and safes and how those impact the valuation if they get not converted when you're taking a look at the valuation.
Yeah, great question. So the question was, with convertible debt and safe, because they have not converted, they kind of have a feature of both debt and equity, and so how that impacts evaluation. And the answer is that when there is a preferred financing, then generally rule of thumb is we're going to lean on that heavily, and in most cases 100% weighting. For convertible debt and for safe, we will look at the implied value and talk through it. And what I mean by that is, if you have a safe and it has a $100 million cap, we'll discuss with you, hey, what type of negotiation went into that $100 million cap? Was it just something that was written down really quickly, or did you guys discuss it in depth? We will always look at the opined value for that, for the convertible debt or the safe, but we won't always weight that. Another way that I always like to tell our clients is that generally, if convertible debt or safe has a cap, that's the ceiling value to that, right? And so what we'll do is we'll utilize a methodology called a back solve, but we'll look at that ceiling value, and then we'll look at other valuation methodologies, and if they cooperate with one another, then yeah, sure, we just have more data points that we can value. But if the safe is suggesting, hey, this company is worth $80 million, but every other indication is indicating $15 million, we'll try to decipher the reason being, but a lot of times it's just because that cap is the ceiling. That's kind of that upside protection, if you will. And then that kind of goes back to, in particular for 409A. A lot of times the ruling for 409A is that it needs to be updated every year, or if there's a material change in the company. Preferred financing, LOIs, generally are considered a material change. Convertible debt, safe, we will usually run a back of the napkin calculation to see how material, and just talk through it with the client to see if there's materiality there. If they are audited, we like to hop on the call with the auditors as well, kind of explain our rationale on why we think it's not material. But yeah, the answer is it can sometimes have an impact on the valuation, but we'll look at it every time. Awesome. Any other questions on market in general? And when we get to the end, we'll actually have more questions as well, so, just a Q&A at the end. So fabulous. So now we get to the income approach. And the income approach, I apologize. Yeah, this is, You guys will get the PDF and it will look much better. But there's two ways to look at an income approach. There's the discounted cash flow and the capitalized earning method. In most cases, we as a firm will use the discounted cash flow just because we're working with private companies, higher growth companies, earlier stage companies. So within the inputs of the discounted cash flow or the income approach, we need projections, and those are generally provided to us by the company, by the client. And then what we will do is we'll pull the other information. So we'll look at market information. We'll come up with the discount rate and everything else like that. So the next slide, please. So financial forecast, I had mentioned this before, but the one thing that we know about forecast, it doesn't matter how good someone is at forecasting, how good of an FP&A team they have, we know that it's going to be wrong, right? That being said, sometimes people they have great teams, they kind of have a great way of forecasting. Other times it's just this shot in the dark. And so a lot of times when we get forecasts, some of the questions that we ask are, hey, are they reasonable? If there's a pre-revenue company that provides us with forecasts and they say they're going to be doing $10 billion next year, maybe not. But we want to kind of understand how reasonable those are. And then how can we accurately capture that risk in those forecasts? Sometimes when we get those, once again, we can talk over the projections, and someone's like, oh, look, I've got a government contract, and they're going to be paying me X amount each year. Those are a lot safer projections than someone who's pre-revenue who doesn't plan on making money for the next 4 years. And then here, yeah, we've kind of talked about, I have an example on the following page, but here, really, you can go to the next page actually. What I wanted to do is kind of just draw out a typical discounted cash flow and how we approach it, or any firm would approach it. So first off, when we receive the projections, we will come up with something, the free cash flow, right? So we're going to come up with the free cash flow for the company. And these numbers are kind of blurry, but those are not present valued. To kind of give you a quick educational piece on finance, how that works is $1 million today and $1 million here in a year from now are not equal to one another. The $1 million today is worth more because here in a year from now, you could have done something with that. And so generally what we'll do is we'll discount that back. So here in a year from now, that $1 million is worth $900,000. And that's based upon the time, how long until you get that money, and then the risk profile to it. So the first piece, we want to come up with the free cash flows for the company. Second off, we're going to come up with something that within the industry is called a WACC, but it's a discount rate. There's a lot of different ways that we can look at discount rates. One very common one for the cost of equity is a CAPM. Also, a lot of times what we can do is we can even select discount rates. So there's a lot of studies out there for venture-backed rates of return, Pepperdine studies. There's a lot of, Duff and Phillips has some studies out there. There's a lot of different ways that we can look at it. And similar to any other approach, we kind of want to cross-check it. If we're coming out with a discount rate using a CAPM of 80%, but everything else is suggesting that we should be in that 30 to 40% range, we kind of just want to test our assumptions. And you can actually go up still on this. So now that we've got our discount rate, what we're going to do, we just discount those free cash flows. As I mentioned, $1 million is not worth $1 million here in a year from now. So we'll discount that. We'll then aggregate that value of the projections that they provided. So in this example, the company provided 5 years of projections. We aggregate, we present value that discrete period. But we kind of, I talked about this at the start, a company is worth all of its future cash flows for perpetuity in theory. And so 5 years is not perpetuity. So what we want to do is we want to apply a terminal value. There's multiple ways that we can apply terminal values, but it's sufficient for me to say that we'll look at a terminal value, apply a discount to that, and then opine on a value for the company as a whole. So in this case, discrete period was worth $7.2 million, terminal value is $22 million, and then the enterprise value is $30 million for this company. So the next page, similar to every other valuation approach, there's limitations. Forecasting, we've already talked about that. Also, terminal values, those can vary, which approach you're using, multiples you're using. Discount rate, there's always, anytime you're using an income approach, the discount rate can have, there's always questions in regards to that because it is very subjective and can swing the value quite drastically. And then within the discount rate, there's also country and company specific risks that can be captured, but those are kind of limitations. So in regards to the income approach, there probably are questions. Any questions for the time being?
Hey, real quick, because we meet a lot of companies where they'll have a great CFO or controller, but they don't have an FP&A team, and the projections are pretty basic.
Yeah.
I mean, you help, do projections, you're evaluating them. If you're having a company put them together, what would be the best way that a company can put together a forecast, a projection that you could use on that income?
Yeah, that's a great question. And so a lot of times for a really early stage company, it's kind of like, it's a shot in the dark for projections. For companies that do have some revenue, and it can even be a small amount, that I'd mentioned this before, it's much easier to project revenue than it is to project profitability. So a lot of times what we ask individuals is it's like, hey, can you at least provide us with revenue projections? And then what we can do is we can either benchmark the margins based off of similar companies. Also, the important piece to kind of know is just to make sure, we always want to make sure that the income approach is coming in close to where other valuation methodologies. So at the end of the day, if someone provides us with projections, we're either going to want to adjust the discount rate so that it comes close to the other valuation methodologies, or we've selected the wrong comparable companies, and so the answer is we always like to get projections if we can. We do realize that a lot of times, especially for earlier stage companies, people are wearing one person's wearing a lot of hats. And so we're not expecting them to have it down to the penny on what they're going to have. Great. Any other questions? Okay, so now the cost approach. We're going to go kind of lightning speed through this one. A lot of different ways that you can look at a cost approach. Generally, a cost approach is for companies that are pre-revenue, and really it's more of just kind of this replacement or kind of how can I replicate this and get back to a similar point. And an example of that would be, imagine that you've got a software company, they don't plan on making money for the next couple years. They've been in business for 6 months now, and they've put some money into engineers and a few other things. Sometimes we can just take that value, how much has been invested into the company. It is a simple assumption that, hey, for every dollar spent, it's worth $1. It could be worth more, it could be worth less, but that's kind of the theory behind it and the thought process behind it. Lots of limitations for the cost approach. But one thing that I did want to mention is similar to as we talked about convertible debt and safes having that ceiling value, the cost approach is a good proxy for a floor value. So if the company, let's say they're a Series Seed company and they raised $5 million. If they have $5 million in the bank, we should not be coming out with a value below $5 million. It's kind of hard to suggest that, especially because for 409A, the permissive value is a going concern, meaning like what's known or knowable, but that you're going to continue to operate as a business. So that's probably a little too much, but it's a good proxy for a floor value. So you can go to the next slide, please. Any questions on the cost approach?
Book value plus discounted cash flows. How do you mix them? Two different approaches. How do you go about that?
Yeah, let me make sure so you're saying if I were to, if I had the book value of the company and then if I were to come up with a DCF as well, like two separate values?
A hybrid between the two approaches.
Yeah. We do that. One way that we'll actually use a cost blend two methodologies together is with a cost approach and a market approach. So if someone has raised pre-revenue company, they've raised convertible debt with a $10 million cap. So they have $2 million of cash in the bank, $10 million cap. We know it's somewhere in between that 10 and $2 million. We'll kind of blend that to come out with a value in between there based off of expectations, negotiation behind the cap, a lot of reasons. But yeah, the cost approach can be blended. And then book value, from the simplest form, can sometimes be a great proxy for value. Other times it needs to be fair valued. Okay, next slide. Now we're getting into the fun, the fun piece, and this is the more technical piece. Is so I talked about how there's two steps for a 409A valuation in particular. First step, valuing the business. Now we've gone through some valuation methodologies. The second step is equity allocation. And what we mean by that is exactly what it states, is sometimes people have very simple cap tables. And when I say a simple cap table, I'm talking common shares. The shares or the units are all equal to one another. In that case, it's basic arithmetic. Company's worth $1 million. There's 1 million shares out there. It's $1 per share, right? Barring any adjustments on like discounts and everything. Where it can get more complicated is generally for VC-backed companies, the capital structure is more complex. And when I say complex, meaning that there's preferred shares. Preferred shares can have economic rights, or do, stated off the name, do have economic rights that are above and beyond that of common. The most common are liquidation preference, participation rights, sometimes conversion. You see dividends, you see all these different ROFRs and everything else like that. So we can move to the next slide. Nothing. Okay. No, that's fine. We'll just that's perfectly fine. So the one thing that that's one place that we're very specialized in, and any sort of valuation firm is specialized in, is in regards to equity allocation, and for those preferred shares. And I had an example in here, but this I'll kind of draw it out. No, those are just more if you can move down a few more. Right there, 34. Thank you. So I tossed up here a simple capital structure and then a more complex capital structure. Now, in this scenario, they're the exact same, but they're different in how we're allocating the equity. The first one is the simple capital structure. You have 1 million shares of common outstanding, and an investor comes in and buys 20% of the company for $1 million. So the pre-money, what most people would use, the pre-money, or 80% of the company is worth $4 million. Then you add in that extra $1 million, or the 20% that new investor bought, and so it comes out to $5 million. Another way to kind of think of that is if you were to take $1 million and divide it by 20%, or 0.2, you'd come out at a $5 million valuation, right? And then with the number of shares, you can just do the basic arithmetic of the $4 million divided by the million shares to come out with a price per common of $4 per share. Where it gets a little more complex is suddenly you have an investor come in. There's a 1x liquidation preference, meaning that the investor gets their money back before common participates at all. The conversion right, it's a 1-for-1. Sometimes you see different conversion rights, and it's non-participating. So a pretty plain vanilla structure in the VC world. Still, the pre and the post money are the same, right? In the pre-money valued on this business was $4 million. The post money is $5 million. The caveat to that is that's assuming that the preferred shares and the common shares are all equal to one another. And in the equity allocation method that we use, that's just not the case. If I came to you today and said, hey, look, you can buy preferred shares from me for $1 per share, or you can buy common shares from me for $1 per share, you'd be buying the preferred just because there are those economic rights above and beyond. The key assumptions that go into the option pricing framework, because it uses Black-Scholes option pricing, are all the inputs. So 5 key inputs that go into it: exercise price, the current price of whatever the underlying security, time, volatility, and risk-free rate. Risk-free rate is tied to the time or the maturity. And you can move forward. I added a bunch of different. And then lastly, I think the most important piece on the equity allocation piece is to understand that with complex cap structures, not all shares are equal to one another. If it's a simple cap structure, they can be. If it's complex, different shares have different values at different times. Now, just getting into valuation adjustments. When we get to valuation adjustments, the 2 main adjustments that we see are a discount for lack of marketability and a lack of control. Now, from a really high level, discount for lack of marketability, it's exactly that. Private companies, they're not publicly traded. If I own an Apple share, I can go onto E-Trade or whatever platform I have, and I can sell it today. It's a liquid market. If I own shares in Silicon Slope, it's going to take me longer to sell those shares, and therefore there's a discount for lack of marketability applied. I kind of already talked over the rationale. Here's a few of the calculations. As with anything in valuation, there's a lot of different ways that we can calculate the discount for lack of marketability. It can be based upon the valuation methodology that we're using, the stage of the company, where they're at, and everything else. And then lastly is the discount for lack of control. So for 409A purposes, the valuation is done on a non-marketable minority basis. And so in some cases, and there have been some changes recently, but in some cases we will apply a discount for lack of control based off of these shares because it is on a minority basis. Few ways to calculate that. Once again, most of the time it is from market information. So, and I showed an example of this. This is actually a pretty high discount for lack of control, but we applied a discount for lack of control within a transaction comparable. So that kind of wraps it up for me in regards to high level on how we approach 409A. I do realize the one thing I did want to do is I wanted to leave some time at the end, because the 409A valuation, sometimes like going through it can be a little boring, but a lot of times people have questions and they have similar questions. I can't tell you how often I hear the same question time and time again. So I wanted to open up to you guys and keep it pretty informal on just any questions that you may have. And it can be in regards to 409A valuations, but also just valuation in general. Yeah, great question. So the question was, what's a typical discount for lack of control that we see? I'd mentioned that 28 was high. I would say probably between 10 and 20%. 20 is on the higher end. But, I mean, it really can range, and it depends on the business. But, yeah, 10 to 20% is probably more reasonable. Yeah, it's a good question. So the question was, you see a lot of different structures, company structures, LLC, S Corp, C Corp. In most cases, when there has been an institutional investor that's come in, it's a C Corp structure. Not always, but the main question was, how do we look at LLCs? First off, it all has to do within the legal agreement. LLCs generally have more complications to them, right? And the reason being is profit interest. And so profit interest can actually be defined in a lot of different ways. And so we have to look at that legal structure and understand that. Where options are very simple, right? Hey, look, the strike price for the option is $1. We can create that on the break point, and boom, you've got that, or the waterfall. For an LLC, we have to really understand if it is a profit interest, how the economics work for that. Second off, a lot of times within LLCs, we see management carve-outs and just a lot of different funky payouts. The answer is we have the opportunity to read through the operating agreement, understand that, and then put it mathematically into a waterfall. And so that's our job, and that's really where valuing a business is one thing, but the equity allocation and understanding, taking the legal piece of it and turning it into a mathematical formula is what we're good at. So it really just depends on the business. It is a pass-through entity, but there's still, we just have to, it's a case by case for LLCs.
Yeah, all the amendments every time you add somebody.
Yep. Yeah. I saw another hand over here.
Yeah. So my understanding is 409A is for valuing stock options, and it's more of a tax thing than, like a valuation for sale or some kind of like transaction, right? Are 409As used at all down the road to value the company, or is it strictly just for tax purposes?
Yeah, that's a great question. So the question was, 409A is used for tax purposes, right? Deferred compensation. Are 409As in particular used down the road for other types of valuations? The short answer is no, they're not used for really anything else. Generally for 409As, we're looking for the lower end of the range because it is compensation. You're trying to hire the best engineers and everything else like that. So we're coming out on the lower end, and it is a tax exercise. A lot of times for gift and estate purposes, depending on what we're doing, the 409A and the gift and estate can look similar, or the price can be similar. That being said, one of the big questions from earlier stage clients of ours is, okay, hold up. I just got a $25 million post-money valuation. With all your adjustments and everything else, you're coming out at $18 million. Is my investor gonna yell at me for now saying that this value is much lower? And the short answer is no. These are never presented in any sort of form like fundraising. And in most cases, what we find is the later the stage the company and kind of the bigger the investor, the more pushback we get for getting the price lower. So it's like, okay, if we're working with an earlier stage company, great, but if we're working with someone where Andreessen Horowitz has come in and invested, suddenly their board member is like, oh my gosh, it's got to be at X percentage of preferred, and we need to drive this down as low as possible, because they understand kind of the ramifications and to get it lower and everything like that. So did that answer your question?
Yeah.
Okay.
I don't quite understand the LLC side of it. I've only worked with C Corps with traditional stock options. Can you help me understand, I guess, the 409A for LLCs as well?
Yeah, great question. So a 409A can be used for an LLC based off of the structure. Really, 409A is just it's the IRS ruling to set fair market value, right? In most cases, people are mistaken and they'll reach out to us and say, hey, look, I need a 409A. My attorney told me I needed a 409A. I'm an LLC. This is the structure. In a lot of cases, we'll title those like common unit, like unit valuations, so the scope is similar a lot of times, but it really just depends on the scope on 409A. In most cases, when it comes down to 409A, though, it is a C Corp. Yes, Chris. Yeah.
Obviously, as the higher the rates go up, the lower the discounting.
Yeah.
So talk a little bit about what you think is going to happen with the rates.
Okay, yeah, so the question was low interest rates. What do I think will happen with that? First off, I'm not an economist, so don't take this as financial advice. I mean, low interest rates suggest money's cheap, right? Which is nice. We've gone through a lot of years now where the investing's been good. With the pandemic, we did see a little of it dry up, and when I say a little of it, money from the VCs dry up. It wasn't as frothy. Valuations got driven down a little. That being said, as of kind of fall of 2020, investments are still going strong. Interest rates, I mean, I keep up on it as well. I think the Fed plans on increasing interest rates over time, but there's kind of this fine balance as well, right? You had the pandemic, so if you increase interest rates too much, that could toss us into a spiral, into some sort of recession, depression. How does that impact valuations? If you have a great company, doesn't matter if interest rates are low, high, if we're in a recession, if we're in a booming economy, you're going to be able to raise money. I mean, we had clients of ours raising hundreds of millions of dollars in April of 2020 when no one knew what was going on in the world, right? That's about all I can say in regards. It's a hard question. I don't do, I'm not a professional investor either. It's just what I see. So that would be my 2 cents on the interest rates.
Can you talk a little bit so 409A, we tell clients that if you're going through and you're getting an informal one, at that point you should probably do one like every year. Is that the cadence you should see, or can you go 18 months, right? Because I know you're a professional
Yeah, good question. Question was, do I need to update my 409A every year, or can I stretch it out? So first off, let's go into the fine print on 409A. The ruling is, you need to update it every year, or if there's a material change. A lot of times what we will do with clients is we'll look at kind of materiality. What has changed over the last year, and how many options they're looking to issue, and everything else like that. So in regards to regulatory, yes, you're supposed to do it every year. In practice, not always. I saw a hand over here. Yeah.
How often do you or Scalar see the IRS coming back and challenging the valuations that are being put out there? And are they doing that at the company level, or do they go as deep as like when an 83B is filed?
Yeah, great question. So the question was, how often are we seeing challenges from the IRS? At Scalar, we know that we have had it audited. We've never failed an audit. That being said, we have seen an increased amount of audits from the IRS, and I think it's because within the industry, it's become much more regulated, but it's still kind of the Wild West. There's a lot of smaller kind of mom and pop shops. There's a lot of just different companies out there. And what they're wanting to do is regulate it and make it much more, because if you want to, you really don't need any sort of credential out there, and you can create a valuation. What they're doing, and it's actually there's been a lot of movement over the last couple of years, is creating a much more standardized form. And it's like, okay, if you are a firm that has these credentials, it's going to be much easier to get through that process. But to answer your question, going back to it, how often do we see the IRS? Depends on the valuation. 409A, generally that has to do more so if they're going through a big exit, it's going through auditors, it's been audited, so it's good. A lot of times we'll see SEC comments or questions. If it's gift and estate, that's much more common, especially on the size, right? If you're gifting $5 million, probably not as impactful. If we're doing some gifting work that's $250 million, there may be some questions, or at least they'll look at it. But very rarely do we run into the IRS.
Are you seeing those increased opportunities targeted across the board, or are you seeing more smaller companies, medium companies, larger companies? Is there a pattern?
Yeah, the question is, are we seeing a pattern on where those IRS audits are coming from? I can't speak to that. I have heard within the community that there have been a lot more questions. For us, it's pretty normal. We work with auditors, and so it's very common to get a question questions from auditors on just underlying assumptions. But we follow strict guidelines in regards to, like in 409A, there's strict guidelines in each valuation methodology. And although it's important for us to help our clients and everything like that, we've built a brand, and so we can't deviate from that brand and get hit up with something. So I'll be honest, once in a while we lose out on a deal because it's like, you can't get this low, and it's like, I can't. And they're like, well, so and so can. And it's like, yeah, it's okay to gamble, just good luck. But yeah.
Is a 409A the wrong tool for creating value to defend what might not be an arm's length transaction, selling it to someone who was already involved or owned it, selling the rest off?
Yeah. So the question was, should I use a 409A if I'm looking to sell my shares? The answer is probably not. So 409A in most cases is coming out on that lower end. You're applying a discount for lack of marketability. You're looking at economic rights. You're just wanting to keep that price low. If I'm selling shares in a company, I want it as high as possible. We do that work, right? So we do consulting work, but I would probably steer clear of like what we would, and that's where a lot of times people get mixed up is, hey, I want a 409A done. We start talking to them, and it's like, actually, yeah, we'll do the valuation, but we're actually going to do it. The scope is going to be this. Yeah.
Last question, and maybe you kind of already answered this, but are you ever using multiple approaches in one valuation, meaning market approach and income approach? And if so, how are you weighing those to get to a single valuation?
Yeah, that's a really good question. So the question was, do we ever use multiple valuation methodologies, so maybe 2 market approaches, 1 income, or whatever it may be? And if so, how do we weight that? The answer to the first question, do we use multiple valuation methodologies? Yes, we actually try to use multiple just because it cooperates with one another. Second off, we want to be pragmatic on the way that we weight it. That being said, in most cases, if the values are coming in close to one another, you've got one at 10 million, one at 10.5 million, and one at $11 million. Generally, we'll just weight it evenly, a third, or something like that. Not always the case, but if they're close to one another. If there is a differentiation, then we want to understand why there's the difference, and then potentially weight 2 separate valuations. But the answer is yes. We actually, most of the time, unless there's a recent security transaction, most of the time we try to weight multiple valuation methodologies.
So what would cause you to weigh like the market approach heavier, for instance, than other approaches?
Yeah, great question. So the question was, why would I weight one methodology more so than another? Perfect example is we actually are just working, we're working with a company right now. They have been quite explosive. And we did a public comparable and a transaction comparable, and the value is coming in, I'm just spitballing numbers, but for both the market approaches is coming in at about $20 million. They provided projections as well, and they have hyper growth projections and everything like that. Even using discount rates and everything else like that, the DCF was coming out at like $27 million, $28 million. So, I mean, when you look at the difference of $8 million on $20 million, it's almost 50%. But talking with the team, understanding, who the CEO, CFO, just the team in general, who they were, what they were doing, it was like, do you know what? We're still going to weight the market approach is some, but we're going to put more weighting on the income approach because they have a plan, they have a vision. So we ended up actually putting 80% weighting on the income approach, which was higher, and then just 10% on each of the other approaches, just in case they missed their projections a little. Does that answer it? Yeah. Okay, cool. Yeah. So the question was like, why use Scalar, or when I'm looking to do a 409A, how do I select a 409A provider? There's a lot of great providers out there. A lot of it, I think the most important piece would be looking at where you're at in your company life cycle. And what I mean by that is, you can go to a Big Four, Duff & Phillips, and I don't know their exact cost, but they're much more expensive than us, right? Let's call it $10,000 or something like that. Well, if you're a pre-revenue company, there's probably no reason for that, even though they are very well qualified and everything. What we like to kind of, for the sales pitch, if you will, for Scalar, is we like to consider ourselves the best value, meaning that we are definitely not the cheapest, but by far not the most expensive. We have the credentials. We have most of the people have come from Big Four or other valuation firms. We know what we're doing. It's going to be done right. Our turnaround time is very quick, but our accuracy is there as well. So that's our big piece, is just best value. And quite frankly, if you're splitting it and it's like, oh, I don't want to spend an extra $500 for it, it's like, yeah, probably then that's great. But yeah, that's kind of how I look at it. Yeah. Yeah. So the question was typical turnaround time. For most valuations, we're looking at about 5 to 7 business days to have a draft ready, and then a couple. Then there's an iterative process. So let's put it this way. This is the engagement life cycle. You engage Scalar. We ask for docs. When we receive those docs, we're asking for about 5 to 7 business days to get a draft. Before we send out that draft, we want to hop on a quick pre-draft call to just talk over a few of the assumptions, right? It's like we might see something, and financials, cap tables don't tell us everything. Hop on that pre-draft call, send out the draft. Then we want to hop on a draft call. Those draft calls can be 5 minutes, they can be 3 hours. We want to explain what we've done, why we've done it. So sometimes people are like, yeah, great. How do I get the price lower? Other times it's like, I want to go through each number and understand that. And we work with all different types of clients, and we're fine with that. And then the finalization, the final report. So at that point, once you're good with the number, you can issue options at that price, but then we'll start working on the final report. That's usually, 5 business days to get the final report. It's more so, it's 50, 60 page report that you toss in your files, that if ever there's a question, it's like, oh, here you go. This is how we came up with that value. Awesome. Anything else? Okay. Well, thank you.
Thank you so much.
Yeah, for sure.
Everybody, please give a round of applause for Jameson. Thank you all for coming out. We'll stay around and answer questions here for a little bit. Please help yourself to more sandwiches and drinks, and have a great rest of your afternoon. Thank you.